Welcome to the second Dunham Quarterly Snapshot of 2024. At the end of every quarter, we share our insights on global markets and the economy, all summed up in a few minutes. Let's hear some insights from a Dunham team member.
Equity markets continued their rise in Q2, driven by expectations that the Federal Reserve is nearing its inflation goal and will begin cutting interest rates by year-end. While equity markets were positive, the amount it's risen has slowed compared to the strong performance in Q1 2024. To put this into perspective, the S&P 500 was up 10.5% in Q1, but has only increased by 4.28% in Q2. Global markets, although positive, also saw a slowdown this quarter. The MSCI All-World Index EX-U.S. rose just 1.11%, a weaker performance compared to their U.S. counterparts. Meanwhile, bond returns showed some improvement, with the Bloomberg U.S. Aggregate Bond Index rising 0.07% after a slightly negative Q1. This reversal can be attributed to both inflation and economic growth slowing down, signaling potential interest rate cuts by the Federal Reserve later this year, and has pushed bond prices higher. Mentioning economic growth, the Q1 U.S. GDP report released in April showed only 1.6% growth quarter over quarter, significantly missing estimates and later revised down to 1.3%. This marks the lowest growth rate since the second quarter of 2022. Now, let's take a short pivot to the government's deficit. The U.S. budget deficit is projected to rise to $1.915 trillion for fiscal 2024, driven by increased government spending. This marks a 27% increase compared to last year, making it the largest budget deficit outside the COVID-19 era. We also saw some meaningful data points highlighting the weakening health of the U.S. economy over the last quarter. For instance, over the last 16 months, 30-plus day delinquency rates on credit cards have continued to rise, reaching 8.9% in Q1 2024, the highest level in over a decade. Similarly, about 8% of auto loan balances saw missed payments over the last year. An index of U.S. pending existing home sales unexpectedly dropped in May to the lowest level ever recorded, as higher mortgage rates and high prices both discouraged potential buyers. U.S. retail sales growth has declined for the last 3 months, indicating a slowdown in consumer spending, and the unemployment rate has risen to 4%, the highest since November 2021. Additionally, the Federal Reserve Bank of San Francisco reports that pandemic-era excess savings have now evaporated, and we believe this evaporation is starting to impact U.S. markets and corporate bottom lines. On the global front, there are increasing trade tensions between U.S., European Union, and China. China is dealing with an economic slowdown and is trying to flood cheap goods abroad to export their way out of a weakening economy. However, the US and EU have responded with import taxes on Chinese goods, which could lead to retaliatory import taxes from China, causing ripple effects throughout the world economy. We believe it's crucial to monitor the situation as the contentious US presidential election approaches. But regardless of who wins, the trade war is likely to deepen, potentially impacting global markets. With all this said, markets continue to rally. However, it's important to note that the upside has somewhat tapered off due to the deteriorating economic fundamentals. It's too early to predict if this trend will persist into Q3, but these are factors we intend to monitor closely.
Thank you for joining us for the second Dunham Quarterly Snapshot of 2024. Stay informed and stay ahead in the markets by subscribing to our Dunham blog and YouTube channel. Until our next update, take care and enjoy the rest of your summer.